So I think for today's session, we're going to talk about will recessionary fears bring entry points for fixed income? And, you know, as we all know, last year was a particularly challenging year for fixed income assets, particularly as the Federal Reserve hiked rates at the quickest pace that we've seen for over 40 years, particularly to counter the sharp rise in inflation. Since then, we've seen the US CPI actually fall back down to below the 4% level, and the Federal Reserve itself has actually kept rates on hold since the end of July. Nevertheless, the current market narrative appears to be that global central banks intend to keep rates higher for longer. And while we have seen inflation actually trend lower, it does appear that the end of the current tightening cycle does appear to be in sight, especially for developed markets. So with that background in mind, let me turn to Andre for the first question. Are we close to seeing inflation peak? And if so, will interest rates be close to their peak as well? And, are we likely to see a tailwind for global fixed income for the second half of 2023 going into 2024?
Yeah, simple short answer is yes. But let me elaborate. If you're looking at interest rates, you're looking at inflation. I think the important part to appreciate is the pace of interest rate hikes. And when it comes to inflation, and if I touch on that first, it's not that long ago that we talked about transitory when it came to inflation. My regret and the team's regret is probably that we didn't speak up louder against that. It was pretty clear that that was not taking place, that was not happening. The same global economists today are talking about higher for longer when it comes to inflation. The same Fed is now saying that rates are going to have to stay a lot higher for a lot longer. I believe more in a classic economic cycle when it comes to this. And you have to start to take into account the pace of the Fed rate hikes. Typically it takes 9 to 12 months for rate hikes to fully feed through into the economy. If you look at where they were 12 months ago, they were at 2.5%. So even to get to where we're currently sitting, 5.5%, it's going to take another 9 to 12 months before we feel the full effect of that. So US is obviously the economy that everyone is looking at and considering. If you're looking at more rate sensitive economies, and what I'm looking at here is actually, if you're looking at the real estate market, the domestic real estate market, in the UK, in Europe, you actually have far more people and investors going into shorter dated fixed or floating rates, so they will feel the impact of rate hikes a lot quicker. We're already seeing Europe, particularly Germany, struggling, Italy getting rates up to unsustainable levels, and we're seeing and experience the same when it comes to the United Kingdom. So do I think the same is going to happen in the United States? Absolutely. So we should be seeing a slowdown coming through. What it also means is that for us, from an entry point when it comes to fixed income, we already feel that rates are peaking. So it's far more attractive when it comes to considering when to get into the fixed income market if you're not only already there. If you're switching to the Asian side, and what you can see on the slide on the right-hand side is, and again, this goes back to what Sue spoke about, what Luke mentioned, far more benign inflation environment in Asia than we've seen in the Western world. That also means that they've been able to hike rates. It has had lesser of an impact, but they already have inflation largely under control. So when the Fed starts to consider to have more of a flat pause, if you like, rather than a hawkish pause. The key reason they're going hawkish is that they don't want people to get excited and fly into equities. They fly into equities, you have a classic recession, they're going to be having to run out of it, and they're going to have to cut rates quicker than they want. They don't want to cut rates too fast. As fixed income investor, we actually are pleased to see interest rates at current levels with the potential for them to fall. The other part people are not considering and looking at too much is also the amount of debt that people have. And I think that has to be discussed. If you have a large amount of debt, this debt servicing of that when interest rates are resetting is actually far more significant. And that also leads to challenges and an increased slowdown when it comes to overall growth. And so the pace of the rate hikes and also the debt mountain that most people are sitting on. And I think majority of people are like Italy. They have far more debt. And that means it's not sustainable. And if you can't service your debt, you're going to have to slow down, cut back when it comes to growth and consumption in general.
Thank you, Andre. So maybe if I can turn to Joe and talk about the US economy. Obviously, It's been quite resilient, but I think it's also fair to say that we haven't really seen the previous rate hikes work their way fully through the system. So that gives us the potential that maybe we do see some detraction in the US economy. How do you feel about that, and how does that impact US bonds?
Yeah, I think in general that would be a positive for US fixed income, just because in that scenario you would see rates come down over time, and that would be make the fixed coupons from these securities actually more valuable. But I think you do have to be careful what areas of fixed income you invest in, though. For example, high yield bonds, they have the potential for their spreads to widen pretty significantly in the event we do hit a recession. And the other thing we're concerned about with high yield bonds as well is that the maturity wall that they have. So many of these lower quality companies have lots of debt maturities coming due in 24 and 25, and the interest rate on those those maturities or those pieces of debt are going to go up quite considerably. So what that could result in is default rates rising in the high yield market. So that's why we really think that the best areas of fixed income to focus on are the high quality parts of fixed income. And that's why we like preferred securities so much, is that they are on average investment grade rated. So high quality companies can make up the majority of the preferred market. So we think they're poised to actually do well in that kind of a scenario.
So just staying with preferred securities, Joe, how have they performed? Previously when the when the central bank has actually paused rate hikes.
Sure, and we love that question. We have a great slide here that kind of shows why. We talk about why preferred securities now, because they really have shown strong performance after the Fed pauses. And what we have on this slide is we show the average market returns of preferred securities after the last 3 rate hike cycles. And we use the 1999 and 2000, 04 to 06, and 2015 to 2018 to calculate the average returns after the Fed pauses. And what we show here in green on the left is the performance of preferred securities, and we compare that versus that of U.S. investment-grade bonds, U.S. high-yield bonds, U.S. treasuries, and U.S. equities. And you can see the preferreds have actually performed really well, in fact, significantly outperforming other areas of fixed income after the Fed stops raising rates. And what's really interesting to see here is the 12-month period where preferreds even outperformed that of U.S. equities. So very strong performance when the Fed stops raising rates, which is, again, why we think preferreds are so attractive right now. We do think we're towards the end of the Fed rate hike cycle, and we think that preferreds are actually poised to perform really well in that scenario.
Thank you, Joe. Andre, if I can turn back to you for a moment. Putting on your hat as the CIO for emerging market bonds and as the lead portfolio manager for our Pan-Asian strategies, do you think the current environment is supportive for Asian bonds? Should investors look more closely at this asset class? And if so, which parts, which markets or which segments do you like?
Yeah, it's a good question, and obviously we prepared for it, and you'll see on the slide now on this page. We think it is attractive. As I said before, interest rates at these levels, they are creating opportunities. If you put it into context, our flagship strategy has been running for the past 14 years. During that period, we're looking at when interest rates and the yield on the strategy is above 5%. In 50 out of 51 observations on that, you're generating positive returns. And on average, you're a high single digit, just under 8%. So what that means is that with rates now in the portfolios, they're sitting just shy of 8%, significantly higher than what we see in most of the times. We absolutely believe you have those opportunities. Furthermore, with the uncertainty we have when it comes to US rates, we actually tilted our strategy to focus on Asian rates, local rate markets in Asia. And if you take a period from the end of 22 till today, you actually have had rate markets in Asia who have rallied, where yields have been dropping while they've been rising significantly elsewhere. 2 examples, China as well as Indonesia. Those are markets where you could benefit from just staying long rates. So if you have a rate position is not a rate position. You need to see how it's built up. So majority of, as I said, what we have is in the Asian space. We switched out of China, not because we don't like it, but because we see a lot better opportunities in in two markets in particular, which you see on the right-hand side, India as well as Indonesia. Indonesia, they have done extremely well when it comes to containing inflation, and at the same time they're providing attractive yields. You're still being paid on 10-year rates in Indonesia, 6.75%. In India, where they have more of an inflationary issue from time to time, but we believe they're going to benefit. And as Sue said, they are benefiting from some of the export being moved away from China into other markets. They're being paid well north of 7% on interest rates. So for us, first and foremost, the rate market. Secondly, we see opportunities in the credit space. I'm not going to speak about China. I'll leave our expert Judy to do that. But we see opportunities in the credit space, not only China, but other markets like India as well, where you're having some pretty interesting sectors that you can benefit from. So for us, it's about building up a portfolio that is not so concerned about what takes place with US rates. When US rates are starting to fall, we'll be aggressively shifting some of the defensive positions into the US rate markets to take full advantage of that. But for the time being, while we are peaking on US rates, we are far more comfortable sitting and having far more exposure to the Asian side. Currencies, real quick, we are far more tactical. We need to see a slowdown, and we actually need what Joe needs, a soft landing for us to switch out the dollars into Asian currencies. If it is an abrupt slowdown, you know people are going to be rushing to dollars, rushing to Japanese yen, and if that happens, we have to be even more cautious. But for the time being, we are still comfortable that we're having that kind of a softish type of landing.
Great, thank you, Andre. Judy, maybe I'll turn to you now. Thanks for sitting there patiently. I've saved the next few questions just for you. So, you know, obviously, beginning of this year, we saw the China market really rally quite strongly. I think everyone was quite optimistic, especially around the rebound trade with the Chinese economy opening up. Since then, in the second quarter, we've seen a lot of market volatility, particularly in the China property sector. From your point of view, do you think the Chinese government is doing enough really to support that sector at this point in time?
Yeah, thanks, Dylan. Yes, we do want to see more from the government. I guess it's the consensus this market also thinking about. But just in terms of the Chinese property story, I put it out there, but I'm not going to go through all these details as to the whole story because it could take more than a couple of hours just to go through it. So in the just in 2 minutes, give you the gist, it all comes down to two things, sales and funding. So in terms of sales in the first half, what happened? After the 16 measures that was pushed out by the government last November, there was a little bit of a recovery in first quarter this year, and then followed by the 5 months of negative trend until August. Give you a bit of a number just to give you the context. The top 100 developer, year-to-date August, it's down, the sales is down 10%. That's including the recovery in the first quarter. However, we are seeing significant polarization within the sector. The state-owned developers, we call them the SOE developers, we are observing many of them, most of them are positive growth, positive sales growth year on year. Some are single digit, and we even see very selective one double-digit growth year on year compared to last year. Whereas you can see that the POEs, the privately owned developers, are down maybe 30% year on year, and the distressed already defaulted names are down 60, 70, even more percent in terms of sales growth. So within that, government obviously has already just announced another round of demand stimulus. I call it home over loan policy, just to simplify how people would think about it. All it is to do with the changing of the first homeowner definition, and therefore whether more homeowners or home buyers can benefit from the preferential down payment and the interest mortgage rates. And therefore, what it essentially is to stimulate upgraders' demand. We've just continued to hear announcement. Just last night was Guangzhou relaxing its home purchase relaxation restrictions, and we have been hearing many of the cities doing, especially T2 cities, doing that over the past month since the home overloan policy announcement early in September. Whether this is enough to go to help the recovery, we'll see. What we are hoping for sales to go back to, definitely not before the crisis level. We're forgetting about that. But in terms of recovery, what we're talking about is, I'm hoping it will go back to first Q levels, first quarter level. Why do I say that? Because that in first quarter, we observed that even slightly weaker POE developers were still operating above break-even sales, whereas in July and August, they are already operating in below. They were above break-even sales, and in July, August, it's operating already at below break-even sales, and therefore the liquidity analysis is drastically different when you're thinking about that. The other thing is funding. Obviously, we are not hearing too much yet in terms of direct stimulus after the November free arrow policy announcement, and we are continue to observing similar things that we saw in the first quarter. In terms of construction loans, we're not seeing banks pulling construction loans at all. So that is at the moment kicking the can down the road. They continue to have access to that. Onshore bonds issuance. Earlier in the year, we saw some of the China bond insurance guaranteed bonds being issued by some of the developers. Not a lot. We stopped in second quarter, and we saw a couple lately, but we're not expecting a lot. Offshore market definitely close to the developers. In terms of equity REITs, equity IPO, it's taking it's progressing, but we're not seeing much yet. So developers still facing significantly tight liquidity situation.
Great. So it does actually sound like there are actually a lot of policies being implemented,
Correct.
but we're still waiting for the evidence in terms
right.
of the actual sales. So as an investor, do we still see value in the property sector, and how should we position, if at all, in that sector?
Yes, so we break the sector down into three buckets. The state SOE developers, as I talk about, in the best position. So they're pretty much operating in above break-even sales, and therefore in a much better position. Yields is back to relatively more normal levels. The second bucket, we think it's more of a sweet spot, which is the POE, but stronger POE developers. How we identify them, it's challenging. But we're looking at the names that have less of a leverage going into the process, and also already diversified away from property development only revenue, so that they already have a lot more recurring income, and also and seeing that development as a business, they're not going to grow that. They don't see in the medium term that's going to come back to the pre-crisis level, and therefore focusing their strategy and specific strategy already in place to see away from that. We see those are more long-term survivors. And depending on your risk appetite, we look also when you're looking into the more distressed and defaulted names, we then will look at whether they have more overseas assets, whether they have still unencumbered investment properties where they can leverage up, and we are hearing from developers that they are still drawing down such loans in August. So those are available. So those developers would be a little bit more, have a little bit more leeway in terms of easing the liquidity position over the next 6 to 12 months. If they can survive through that, sales hopefully come back, and they'd be able to drive those values from, and we look at that compared to the very depressed price now.
Right. And, if we set aside the Chinese property sector for a moment, are there other sectors that you like, either within China credit or more broadly across Asian credit?
Yes, there are still sectors that we like. If we look at, the government policies from the July Politburo meeting, that we have identified a few themes that we think that will support this sector. It's consumption, technological advancements, and clean energy. China Tech, therefore, is a sweet spot that we see that consumption after reopening, it's helping. The graph I put in there just to, rather than just looking at consumption number, I think you all already know about that. That is that within consumption, the recovery is not even. We are seeing a lot higher growth. This is at time spent, and therefore indicator of which tech platform that will benefit from the consumption coming back a lot more. Local services is a lot to do with food delivery. It's still also online hotel bookings and everything. So we are seeing tourism consumption that it's coming back a lot better than overall consumption. So that's how we identify within China Tech where the opportunity lies. Also in high yield Macau gaming, it's also benefiting from those consumption, especially tourism consumption trend that is coming back a lot faster than overall consumption. For gaming sector, the gross gaming revenue, it's back to around 60 to 70% pre-COVID level already. We think there are more positive catalysts still for other than just already benefiting from the reopening. We're not seeing a lot of tourist visitation, not as much as before COVID. So that is a positive catalyst for Macau gaming as well. So that's in the gist. It's where we're seeing opportunities.
How about outside of China?
Yes, outside of China, I think Indian renewables would be also a sector that we like, and that's more, I guess, defensible compared. It's relative, right? It's all relative to the China property crisis that we're looking at, and also other sectors. I guess in terms of a big sector, you can't really find a significant sector as part of the Asia compared to China. But I have to say that within each sector, that it is careful credit selection, that it's important in every sector that we are able to find opportunities, like I said about property sector, that we are still able to find. It's challenging, but still able to find opportunities within those sectors.
Great, thanks a lot. So I think we've heard from each of the speakers, talking about their areas, Joe for US bonds, preferreds, Andre, obviously Asian local markets, and Judy with, China and Asian credit. Maybe on the flip side, if we consider, are there some pitfalls or market risks that investors should be aware of, and how we're protecting our investors from such risks? Maybe if I can start with you, Joe.
Sure. It's obviously hard to predict what potential market pitfalls could be. For example, we didn't expect what happened with Silicon Valley Bancorp earlier this year. That was not on our radar. So I think for us, it's really just important to focus on very high quality companies. And we have a great team of analysts and PMs to kind of help us maintain that quality bias in the portfolio. But I think what really makes us different, actually, is our overweight to the utility sector. These are U.S. utilities that are regulated businesses that have very stable cash flows and earnings. And one of the things that we really like about the utility sector as well is that their fundamentals are very, very positive. Some of the best fundamentals I've seen actually in the space in 30 years. And that's really being driven by the fact that utilities in the U.S. are leading the transition to renewable energy in the U.S. by shutting down old coal plants and building wind and solar. And because they're regulated, they get regulated rates of return on those investments, which is really resulting in very visible 6 to 7% earnings and cash flow growth annually for the next 10 years. So very, very positive fundamentals in the utility space. But on this chart, we actually show that the utilities that actually perform very well. You can see that, again, driven by those visible cash flows. And what we do on this chart is we show the performance of electric utilities in green, and we compare that with natural gas, which is actually natural gas utilities. And we also compare that to the preferred market, overall preferred market, and the banking sector. You can see that the electric utilities have actually performed really well and outperformed. In only one time period was a 3-year time period where they did not outperform the other parts of the preferred market. And what's really interesting to see here is that the 5-year time period where electric utilities and natural gas utilities significantly outperformed the overall preferred market and the banking sector. So, which is why this really kind of, we think, helps us avoid potential market pitfalls, because we do have this significant overweight to the defensive utility sector.
Right, and can I turn to you, Andre? Are there market risks that investors should be aware of?
Yeah, definitely. And again, if when you heard me earlier on, I'm saying we are expecting rates to peak, we're expecting inflation to continue to come down based on how the cycle is playing out and how it should naturally then progress. The clear risk there is, what if commodity starts to rise back up again? We see pressure on oil prices. If inflation turns out to be more sticky and you're actually having Fed, instead of having a hawkish pause, they're moving to hike again. For us, if that plays out, we're going to continue to find defensive areas within the region to continue to place ourselves in, and just make sure that we don't move away from that till we are convinced that this slowdown is actually taking place. And as I said, that's going to take a little bit of time, but whichever way it goes, if you're having to sit longer on the defensive side, we'll do so. If we can go in and get more aggressive and really try to start a benefit and harvest returns, then we'll do that.
Great. And how about you, Judy? Are there any risks that we need to be aware of?
I guess I'm not sure what LGFV means to the audience here. So I'm afraid it's the local government financing vehicle. I had a little bit of it to talk about in the earlier slides. It's because that, well, compared to whether we find an opportunity, it's definitely a sector we find it very difficult to identify values in. We are in it, but we're very extremely selective. But as a whole, it is a 50 trillion RMB problem. That's how much the banking sector is exposing to this sector, compared to the property sector, where the banks have only around 30 trillion RMB exposure, and you can see the scale of it. And there's a lot of market talks about whether it's going to be the next, after the property crisis, is that going to be the next sector that we're going to see a lot of defaults? We don't think. Our base case is we don't think it's going to happen in the next 6 to 12 months. It's slightly different from property in that it is local government linked, and therefore the reputation and also linked to the government, but also the magnitude of it. And therefore many expect, and we agree, that the government will do it in a very controlled manner. They have pushed out the debt swap program with the local government debt or provincial government loan, but also latest after the July Blue, also pushing out a more comprehensive debt restructuring program. Details to be seen, but I think it will be over time that they can. They'll be able to solve that. It takes multi-year, I think. But we're more worried about the policy missteps. That if it creates a systemic issue, whereas the government time and again and saying that they don't want this to happen, and we believe that the government will be doing whatever they can to try not to have an LGFV crisis, just like the property crisis that we have seen. But nevertheless, at this point in time, we see a stark polarization within the sector, and therefore very selective within that.
Right. So it sounds like there are some potential risks out there, but nothing too nasty that we need to be concerned about at this point in time. Maybe if I just turn to my last question before we open up to the floor. This one's going to be for you, first of all, Joe, and then I'll follow up with Andre. How does Manulife stand out in the preferred space compared to our peers?
Yeah, I think really what makes us different is that we're actually fairly small and nimble. Even though we are one of the larger preferred managers globally, we're managing just over 4 billion. We're small enough where our best ideas can still make a difference in our portfolio and really drive performance. And that's really different than some of the mega funds out there whose their best ideas really can't make that much of a difference in terms of driving performance. One of the other things that makes us different, I mentioned the utilities. But I think the last thing to mention is that, unlike many of our peers as well, we can invest in all types of preferred securities. So we can invest in retail preferreds, which are mainly fixed for life preferreds. And we can also invest in institutional preferreds, which are mainly fixed to floating rate. So depending on what area of the what part of the business cycle we're in, we can choose the right preferred to help us outperform in that particular market environment. Again, this is different than many of our peers. They can only focus on, many of them only focus on one part of the preferred market, whether it just be institutional or just be retail. That's really what makes us different.
Great, thank you, Joe. And Andre, can you elaborate a bit why Manulife is well placed to take advantage of the upcoming opportunities that we expect in Asian bonds?
Absolutely. You all heard Michael speaking earlier on. Michael has been instrumental in allowing us to build up, I would argue, the strongest and the best Asian fixed income franchise there is in Asia. 15 years ago, we had 12 people. Today, we have 70. We more than quadrupled the assets that we are running. During that period of time, we built out a really strong credit research team. Judy is heading up and overseeing everything we do in North Asia. We've been able to continue to do what we think is really important, which is strong fundamental bottom-up credit research. Take an example as when COVID started to play out, we moved 3 analysts to Shanghai to make sure that we had enough people onshore. So we knew that borders were going to close down, but we were able to do that. And all that because the organization was supporting what we were doing. So finding the opportunity set, having a team that is spread across the entire region in 10, 11 different locations, and continue to hold on. A lot of you have met our colleagues across the region. You see the same people today as you did a decade ago. So that speaks to the strength, stability, and the diversity we have as a team. And that also makes us having the ability to be nimble and dynamic when it comes to finding the opportunities, and also knowing what to do with the strategies if things doesn't go right. How can we change it? How can we fix it? So yeah, that team is what sets us apart.
Perfect. Thanks a lot, Andre.